Okay, have you ever looked into buying a house and just felt completely overwhelmed? I mean, there's so much noise out there, so much bad info, and it can keep a lot of us on the sidelines. So in this explainer, we're going to cut right through that confusion and bust the biggest myths about one of the most popular and misunderstood ways to buy a home, the FHA loan.
Yeah, let's just start with the big one. This feeling, right? This giant, impossible mountain that stops so many people before they even get started. You do the math in your head and you're like, seriously? It's gonna take me a decade to save that much? It's a huge source of discouragement, and honestly, it makes total sense.
But what if that whole 20% rule and a bunch of the other rules you've probably heard aren't really rules at all? What if they're just old stories, these myths that have been holding people back for years? And that is exactly where FHA loans come in. We're going to look at these loans which are backed by the Federal Housing Administration, not just as another mortgage option, but as this amazing myth-busting tool that's already opened the door to homeownership for millions of people. So, what even is an FHA loan? Well, at its heart, it's a mortgage that's insured by the government. Now, that insurance isn't for you, it's for the lender. It protects them if a borrower can't pay. And because the lender has that safety net, they're way more willing to say yes to people who might not fit into the super strict box of a typical loan. Let's kick things off with the number one hurdle for most people, the money. We're talking about those myths that make you feel like you need a giant pile of cash just to even start the conversation. And here it is, the big boss of all home buying myths. This idea that you have to have 20% of the home's price saved up. For a $300,000 house, that's $60,000 in cash. It's a ridiculously intimidating number. But here's the truth. And seriously, this is a total game changer. That 20% thing, it is not a hard and fast rule, especially not with FHA loans. This is where the whole game changes. This is the number we should be talking about. Just 3.5%. That's the minimum down payment you need if your credit score is 580 or higher. So on that same $300,000 house, we're not talking $60,000 anymore. We're talking $10,500. That's a world of difference. It makes the dream feel so much closer, right? Oh, and it gets even better. This busts another money myth right here. Not only is the down payment way lower, but the FHA says that 100% of that money can be a gift from a family member, your employer, even certain charities. You don't have to have saved every single penny yourself. Now, of course, there's a trade-off. To get that low down payment, you pay for something called a mortgage insurance premium, or MIP. And it's really important to get this. MIP protects the lender, not you. It's kind of the cost of entry for getting those flexible terms. And a little heads up for the long run, if you put down less than 10%, that MIP is usually there for the entire life of the loan, unless you decide to refinance down the road.
Okay, so the money side is way more flexible than people think. So that leads us to the next big myth. Who can actually get one of these loans? This is all about the idea that you have to be this perfect borrower on paper.
We've all heard this one, right? You think you need a spotless credit report and a massive salary to even think about applying for a mortgage. And that belief just sidelines so many people who assume they'd never make the cut. But again, that's not the reality. FHA loans were literally created for people who don't have perfect credit. That's one of their main jobs, to open the door for folks who might get locked out of the traditional lending world. So let's look at the real numbers. Like we said, a score of 580 or more gets you in the door with that amazing 3.5% down payment. But check this out. Even if your score is down in the 500 to 579 range, you could still get approved. You'll just need to bring a 10% down payment. That kind of flexibility is something you just don't see with most conventional loans. And what about that huge income myth? Well, get this. FHA loans have no income limits. Lenders don't really care how much you make, they care about how well you manage the money you do make. And the way they measure that is with something called your debt-to-income ratio, or DTI. It's just a simple comparison of how much you owe each month versus how much you earn. And you can figure this out for yourself super easily. First, just add up all your monthly debt payments, your car loans, student loans, the minimum payments on your credit cards. Then you just divide that total number by your gross monthly income. That's your income before taxes. And that percentage you get, that's your DTI. It's a really key number lenders will be looking at. All right, one last myth in this section, that FHA loans are only for first-timers. And while Yeah, they are super popular with first-time buyers. It's not a rule. You can totally use an FHA loan even if you've owned a house before. The only real catch is that the home you're buying has to be the main place you live, your primary residence. Okay, so we've busted myths about the money and the borrower. But what about the house itself? This brings us to our third and final category of myths, the rules about the property. There's this idea out there that FHA appraisers are just these super strict inspectors looking for any reason to kill the deal. But when you really break it down, the FHA is just checking for three pretty basic, common sense things. And these really get to the heart of what the FHA is trying to do. The property just needs to be safe, no exposed wiring or anything. It needs to be secure, so it protects you from the weather. And it needs to be sound, meaning it's structurally okay. No major issues with the foundation or the roof. See? These aren't meant to be deal killers. They're protections for you, the buyer. And here's a really cool, surprising twist in the property rules. You can actually use an FHA loan to buy a property with 2, 3, or even 4 units. Yep, as long as you live in one of the units, you can rent out the others. It's a strategy called house hacking, and it can be a super powerful way to have your tenants help you pay down your mortgage. So, we've busted the big myths. An FHA loan is clearly a powerful tool, but is it always the right one for everyone? Let's put it head to head with a conventional loan so you can really make an informed decision for yourself. Okay, this chart really lays it all out pretty clearly. A conventional loan might have a slightly lower down payment at 3%, but you'll need a stricter credit score to get it. Now, the biggest difference is probably the mortgage insurance. FHA loans require that MIP on almost every loan, often for the whole time you have it. Conventional loans only need what's called PMI if you put down less than 20%, and you can usually get rid of it once you've built up enough equity. And finally, FHA is for your main home only, while conventional loans can be used for investment properties. So the best choice really comes down to your personal situation. In the end, buying a home isn't about trying to fit into some perfect little box. It's about finding the right key for your unique financial door. All the myths we talked about today, they just build walls. But knowing the facts can turn those walls into doorways. So the only question left is, which one are you going to walk through?